Hey. Hi guys. Welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, veteran stock markets and derivatives trader, analyst at Cointelegraph. On today's Macro Market Show, we'll be explaining how the US government debt downgrade is negative for Bitcoin, at least over the next 6 months. Plus, we'll discuss whether Europe's latest stress test showing 3 banks on risk has been causing waves in Germany. Today's show will start by discussing the US government debt downgrade by the Fitch Rating agency. Wall Street Journal: US downgrade sparks sell-off in stocks and bonds. US stocks and bonds suffered a wave of selling after America's credit downgrade, sending treasury yields to the highest levels of the year. Major index toward their worst session in months. The S&P fell 1.4%, while the tech-heavy Nasdaq lost 2.2%, the worst one-day performance since February. Okay, so late in the day on August 1st, a significant event occurred within the financial world. Fitch, a reputable credit rating agency, downgraded the credit rating of the US government. Yes, from the pristine AAA to AA+. This signaled diminished confidence in the government's ability to handle its fiscal responsibilities, namely paying its own debt. Rising bond yields shift the calculus for many investors, deciding where to park their cash at a time when the S&P 500 has rallied almost 18% this year. So, this is an important part of the article, maybe the most relevant one. So there's 2 information there. First, the S&P, so basically the stock market index, was already rallying 18% in the year. So any neutral to negative news would have caused consequence, like profit taking. If it was the other way around, maybe if the stock market was down on the lowest level in 6 months, I don't know, maybe the market would have said, well, this is already priced in, people were already expecting a rate decrease, so no changes, or even worse, the market would have dropped 5%. But the thing is, investors were expecting some reason, some news to justify reducing the stock market position. So that's what's caused the crash, not the news itself. It's a single credit rating agency. So what the downgrade has done is change the investors' sentiment to a little bit more cautious. So some moved their money out of liquid assets, so profit took on silver, on oil, on equities, on long-term bonds. Instead, they favored cash and short-term instruments, which are perceived as the safer options in uncertain times. So let's go to the 10-year Treasury note yield chart. So when there's lower demand, when investors are selling those bonds, the yield goes up. So that's exactly what happened on early August. The yield moved from 4% all the way to 4.20%. So investors were offloading their 10-year Treasury notes. But the truth is, the movement was already happened. It started mid-July, when the yield touched 3.76%, 76, and started moving up. It just continued to gain. So it was not the downgrade itself that caused the spike. It was already heading that way. What exactly is this 4.2% yield? What does it mean? Well, given that the market believes that the current 5.5% FONC rates are unusually high, basically, the market is saying that the current 5.5% FONC, the Federal Reserve interest rate, is unusually high. So it's going to be dropping in the future. Even the 2-year note is trading at 4.3%, indicating strong demand for buying those assets, given that the inflation is currently at 3%. So even if the yield went up, means the investors are selling, there's still a huge demand for that, because investors know the current inflation is 3% and the yield is paying for 2 years, 4.3%. So it's a 1.3% theoretical gain if the inflation remains at 3%. Basically, the investors are saying, well, we're comfortable on holding a 4.2, 4.3 yield paid throughout 2 years, as inflation should not move above that threshold. And even if it does, I'd rather stay on the most safest assets possible, meaning US Treasuries or cash, which is guaranteed by the government. However, not everything looks rosy, according to Moody's, another rating agency. Their report from May hinted that a potential domino effect could take place in case of a US debt downgrade, impacting the financial sector. Notably, only Fitch and S&P have downgraded the US debt to AA+, while Moody's still holds the AAA with a stable outlook. Interestingly, the cost of insuring the US sovereign debt against default, as indicated by the CDS or credit default swap, has largely remained stable after the downgrade, a surprising development in face of such significant news. The CDS is a financial instrument that protects against the risk of default, working similar to an insurance policy, where investors pay a premium to receive compensation if the issuer of the debt, in this case the US government, defaults. So here you have the 5-year Treasury bill CDS. It was trading at 65 basis points back in May, but since July it has been nearing 30 basis points. And it had stood over there over the past week. So the CDS, the credit default swap risk of the United States, hasn't changed over the past week. But why are investors not panicking after the downgrade? Well, a potential reason is that the US Treasuries is considered one of the safest assets in the world because they are backed by the US government. They can simply print more money to pay the debt. So the issuer guarantees that we will repay it in a specific maturity date, including interest. Of course, if you have more money in the world, it means that your dollar is valued less, but still you're going to pay the debt. So apart from the treasuries dynamics, it's interesting evaluating the DXY index, the dollar strength index, which gauges the dollar value relative to other fiat currencies. A drop in the DXY index leads to reduced faith in traditional assets, and investors might seek alternative value stores, potentially boosting Bitcoin's appeal. But unfortunately, the opposite has been happening over the past weeks. The DXY index has been gaining strength, moving from 100 or 99.5 in mid-July to the present 102. Yes, this trend can change in the future, but right now the dollar is gaining strength against other fiat currencies. This proves that investors are moving away from longer-term treasuries, selling stocks, equities, and commodities to seek refuge, to seek protection in cash and short-term treasury notes, highlighting the dollar's appeal during uncertainty. Consequently, Bitcoin is currently under pressure after the US government debt downgrade, at least for the next couple of months. The initial flight to quality movement often overlooks the benefits of a decentralized asset during this market turmoil. Just to highlight, that's my own personal opinion. It does not reflect Cointelegraph's official view, nor investment advice. Now let's move to Europe, more specifically on the banking sector. European Union stress test shows 3 banks falling short. 3 banks from the European Union failed to meet binding capital requirements in a stress test that saw a theoretical $546 billion wiped from their buffers. The European Banking Authority, EBA, said the test covers 70 banks, representing approximately 75% of the banking assets in the European Union. Of the 14 German banks tested, 8 were below the European Union average for CET1 and leverage ratio. So a bank stress test is a simulation of how a bank would fare in a hypothetical adverse economic scenario. It is used to access the resilience of a bank's capital and liquidity positions and to identify potential risks. The European Banking Authority, EBA, is an independent European Union agency responsible for the supervision of banks in the European area. It coordinates the European-wide stress test, which is conducted every 2 years. In what the watchdog described as its toughest test yet, it examined the impact of a 3-year scenario to 2025 of credit, market, and operational risk losses on a bank's mandatory core capital buffer. It included economic growth slumping by a cumulative 6% and big falls in property prices. So basically the GDP declining 2% per year. Under this adverse scenario, all banks except 3 met the TSCR, the EBA said. So their pessimistic scenario, the stress test, is a mere 2% GDP drop for 3 consecutive years. This might sound pessimistic, but in reality, it isn't. The core reason is that those models are not able to calculate what happens in liquidity, more specifically, the order book debt. For instance, what are the consequences if the US government withholds the yield of debt held by China? At the very same moment, the demand for those treasuries would change, as investors would perceive an additional risk of trading the instrument. Moreover, in case of a 2% slide in the GDP, what sectors are most impacted? How leveraged are them? The big tech companies, for instance, are usually well-funded in terms of cash. On the other hand, real estate and energy companies are usually highly leveraged and ultra-dependent on production and consumer data. Now, what banks are overly exposed to those sectors in terms of debt? I bet the EBA has no idea, especially if one considers derivatives instruments. Anyway, those are just a few examples of how useless those stress tests really are. Everyone knew how risky Credit Suisse and Silicon Valley banks were, but no one expected the investors' confidence on those institutions to erode so quickly. It's all a matter of appearance, regardless of the effective liquidity conditions. It's just the fiat world. It doesn't make sense, but it's just how it is. Well, that's it for today. I hope you guys enjoyed the show. Remember to like and subscribe the new Cointelegraph Markets and Research YouTube channel. See you!